It's almost 11 a.m. in Singapore, 1 p.m. here in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. The Fed makes an outsized rate cut to fend off mounting risks to the labour market. Chair Powell pushing back against criticism that he's behind the curve.
We don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind.
Also ahead, bearish bets on Chinese assets are expected to continue as consumption sees no big boost from the holidays. Plus, we get the market's outlook from Gary Dugan, CEO at the Global CIO office. Later on, we'll hear from Blackstone Private Equity's Asia head, Amit Dixit. Let's have a look at how Asia markets are tracking, however, this Thursday afternoon in the Asia Pacific. And it's a broadly risk-on day, particularly when it comes to the Nikkei, better by 2.5% at the moment. Perhaps a function of a rapidly weakening yen. The yen right now hovering around 143.19. Now, you might think that that is a somewhat counterintuitive mood, considering the 50 basis points of tight easing that we just saw from the Fed. However, Jay Powell saying that 50 basis points is not the new base case. So according to the Bloomberg MLive blog, do not expect this to last. MLive saying this is a classic sell the fact reaction following that long-awaited start to the easing cycle. Elsewhere around the region, we are seeing a little bit of strength now for the CSI 300 after a slow start, better by 0.8% in China there. The Kospi, the only soft market at the moment, only off by about 0.1% right now. Here in Australia, the ASX better by 1/3%. It is, of course, the Reserve Bank of Australia out of the blocks next week. We're not expecting any change there. And the Bank of Japan will announce its rate decision tomorrow, and we're not expecting any change there either. All right, let's hear from the man of the hour, Jay Powell. This is what he had to say when announcing that 50 basis point reduction to the Fed funds rate. Let's have a listen.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
So the Fed's decision to cut by 50 basis points, though, not unanimous. Michelle Bowman cast the first dissenting vote by a Fed governor in almost 2 decades when it comes to a cut. She preferred a 25 basis point cut instead. So for more on what this means, let's bring in Bloomberg's Asia economics correspondent, Katya Dmitrieva. So Katya, what was Michelle Bowman thinking here?
Well, she was probably thinking that it's not quite time to make these big cuts because she's more focused on keeping interest rates higher to really be 110% sure that the inflation risk is completely in the rearview mirror. It's not just a big size and scope in terms of the first Fed governor to do this in many years. It's also a dissenting decision in what would be kind of the opposite way. It's not for a looser monetary policy. It's to keep rates quite restrictive. So I think taking this message as this is, perhaps in her mind, inflation threat is not necessarily over. But if we listen to Fed Governor Powell's conversation earlier with reporters and his press conference, it was really clear that he wanted to underscore that generally the Fed members are moving in the same direction when it comes to inflation, when it comes to the path of interest rate policy for the rest of the year. So the dot plot actually moved together this year as well as next year, seeing a few more cuts. And he really made sure to underscore that the economy is doing well, the labor market is doing well, so that the markets don't take this 50 basis points as the beginning of this aggressive rate cycle. So that was a really important press conference, I think, for markets as well, who kind of repriced in a flurry of action after the decision this morning.
Yeah, and as we just heard from Jay Powell there, 50 basis points, not the new pace. He was pretty clear about that. So where to from here? Do we see 25 basis point cuts at the next couple of meetings? What's the plan?
Yeah, if you read into exactly what the Fed governor and members are seeing, it's a few more 25 basis point cuts. But there is a lot of uncertainty, and I think that's something we should expect for the next 3 months, unfortunately. And a lot of the central banks across Asia, it's the exact same story. You know, we had Indonesia cutting today kind of unexpectedly. We weren't really seeing that happening for at least another meeting or so. And other central banks will have to make their own decisions. The difference this time around is that we have a lot of Asia central banks focusing on their own financial conditions, on some banks where inflation is still an issue. So we're going to see kind of a divergence across the region and potentially globally.
Yeah, absolutely. That Fed decision now out of the way. And we do have Japan coming up tomorrow, a different set of circumstances there, as you describe, and different again here in Australia when the RBA meets next week. So what sort of response do we expect from central banks in Asia?
Yeah, the RBA is actually supposed to hold, but you know, as we've seen with Indonesia today and other central banks, and even with the Fed, you can't always read into the economic surveys and think, even though the majority or the average thinks one way, it's going to happen. So we could be surprised as well from RBA and others. But we do expect to hold this week. From Australia, New Zealand, we're definitely going to be having some cuts because the economy is on the brink of potentially another recession. But as for the other economies, you know, just wait and see for the next month or so. So October, there's going to be kind of 6 to 8 central banks in an 8-day period, all deciding policy. So that'll be another important one to watch. You know, we thought we're going to get the Fed over with and then move on, and you know, things will be calmer this year. Well, actually, no. At least for Asia region, we're going to get mid-October another flurry of decisions.
Yeah, just getting warmed up. Bloomberg Asia economics correspondent Katya Dmitrieva there. Now, we asked JP Morgan Asset Management's global head of fixed income, Bob Michael, about what the Fed's jumbo cut means for bonds.
We're telling clients, just get into the bond market. Just get into a general bond fund. It could be an aggregate investment grade bond fund. It could be a core plus bond fund if you're in a high tax bracket. Get into a general municipal bond fund. Yields are coming down.
Well, our next guest was hopeful that the Fed would deliver a 50 basis points rate cut. So let's bring in Gary Dugan, CEO of the Global CIO Office. So, Gary, you got your wish. 50 basis points it was. The market now seems to think that we're firmly in an easing cycle. So what's the next move from here for the Fed?
I think the measured pace that Powell set out, you know, you've got your 50 basis points that we'd hoped for. That's an emphatic signal that interest rates are going down. But I think he was also cautious to say that, you know, that he didn't want people to take away from his press conference that there's a problem out there. There's a big problem of growth, that the word recession was not to be used. So he was saying we will be measured in our rate cuts because we believe the economy out there is still relatively robust. But, you know, we've beaten inflation, and hence we can ease policy down to a more neutral level.
Yeah, where are we in terms of the soft landing versus recession debate in your view? Because a half-point cut would normally suggest a need for some urgent support. Do you have any change in your expectations, especially considering the jobs market in the US?
No, I think the reason they did the 0.5% or 50 basis points was because they were late on this move. They should have moved at the last meeting, in my view, and other economists have stated the same thing. So there was a bit of catch-up. I think they're ahead of the curve now. I think they're giving a bit of easing and assuming that the economy will be, you know, muddling through. But there's no stress here about a recession. I think if you look at the micro data, company to company, there's no one saying that sales are collapsing. If they are collapsing, it's often because those companies are uncompetitive in their market. So I think there's a good robustness to the US economy, but growth has clearly dropped, inflation's dropped, and it did warrant that cut in interest rates.
In terms of whether or not the Fed was late, it was interesting to see that dissent from Michelle Bowman. That was the first time a Fed board member had issued a dissent on a cut since 2005. So in a way, does that reinforce Chair Powell's claim that the Fed's not behind?
to an extent, and I have some sympathy, and I think there should have been, there had to be someone out there and just basically raise the flag and said, you know what, we've still got a question mark over inflation. And the reason I say question mark is that if you look at those core service numbers, they're still up above 3%. So there are elements of the inflation basket that are still strong, still troublesome, and still of some concern to the central bank. So I think it was kind of helpful that at least one member of the FOMC put their hand up and said, no, I prefer to move more slowly because I still believe there's an inflation risk out there, and we should be mindful of that.
Well, we've seen some pretty interesting moves in the dollar off the back of this. We've got it strengthening particularly against the yen, but also against a lot of the G10 basket of currencies. Has this decision caused you to change your allocations at all and perhaps look at EM Asia in a new light?
I think it certainly opens the door, as we saw with the Bank of Indonesia today, for a general easing across the region. And, Asia's really been a backwater for investors. It's been very, very focused on the United States in terms of returns and the tech industry. But I think in this easing cycle, Asia's the part of the world that can catch up. Asia's the part of the world that could deliver some good returns, excluding, unfortunately, China. But we do believe that there'll be a good cycle here of interest rate cuts, and I think greater optimism within the region.
Yeah, I want to get to China in a moment after the break, but I just want to talk about what we're seeing in Japan as well. I did mention the weakening yen there. We're seeing some pretty good gains on the Nikkei. How do you approach trading in Japan at the moment, particularly when you consider the next move, even if it's not on Friday, from the BOJ, is likely to be higher?
It is, but I think it's a great move here to a normalization of Japanese policy. So we have interest rates going up. We have stronger inflation than we've seen for decades. We have consumers-backed spending. At least in recent months, we've seen some good data. So the normalization, even if it means higher interest rates, is actually good news for the Japanese asset markets.
So where are you looking to put money to work in Asia at the moment?
Well, everyone's in a love affair with Japan, and I still believe there's more upside. We are a little bit cautious in the way in which we approach it. We do hedge some of the currency risk in holding certain part of our portfolio's Japanese exposure in a hedged share class in a mutual fund. But elsewhere, I will continue to buy the ASEAN basket. It has performed well over recent months, but the performance of REITs, the performance of the banks, the financials, which are a large weighting in many of these indices, could still drive that index higher.
All right, Gary Dugan of the Global CIO Office is sticking around. We'll get your thoughts on China next, and also ahead on Bloomberg Markets Asia, our exclusive interview with Blackstone Private Equity Asia head Amit Dixit. We're going to discuss their M&A strategy for the region. That conversation just ahead. This is Bloomberg.
I see investing in China as largely a very attractively priced place that now has a lot of questions regarding the issues that I've just referred to. In other words, the economic issues and the political issues regarding property rights and whether it's still glorious to be rich and how that'll work. Therefore, there's a small percentage of our portfolio which is in China and will stay in China, through this process.
That's Bridgewater Associates founder Ray Dalio there speaking to us at the Milken Summit in Singapore. And investors got little clarity from the latest economic data out of China. Chinese consumer spending edging up only slightly from pre-pandemic levels during this week's holiday, failing to ease market concerns over the economy. When measured per trip, spending during the three-day period grew by less than 2% from 5 years ago. Well, Gary Dugan, CEO of the Global CIO Office, is still with us, and he's of the view that China's equity market is increasingly uninvestable. Gary, some strong words there. What would you need to see in terms of policy to change your view on that?
Yeah, see some consistency. We need to see to change the market dynamic to one where it's just an option as opposed to something you want to feel committed to. And that commitment can only come back if we see constant supportive policies from government, or even just talking about the need for a stimulus, or talking about the need to give clarity to investors as to how they're going to invest. So without that clarity, people are feeling, listen, I'm just going to leave this alone. This is too much of a headache. It's too much risk. And therefore, I'm just going to take China out of the benchmark that I follow, and I just won't bother. And that will be a sad time for a market that's still and a country that's still a very considerable part of global GDP.
Do you think that there is a point that the market might force policymakers in China to resort to bazooka stimulus, which is what seems to be the pressure growing for it, or is this just never going to happen?
Well, quite honestly, I don't think it matters what the foreign investor thinks. I think it's going to be the mood in the country. And if the leadership wants to improve confidence, it can certainly do it at a whole household level by putting more money into people's pockets and giving them a feel-good factor. But also, it's got to make its asset markets more vibrant. And clearly, it doesn't want to do that in the real estate market that needs to see a price fall and needs to see a reset. But the equity market is still an important source of funding for Chinese companies. So I would have thought at some stage soon, the government's got to step in, as we've seen in the past, and you'll see the domestic institutions buying the market, and that could then bring the householders back in and then brings back the foreign investor.
In terms of the foreign investor, though, can that actually happen in the current geopolitical environment? Because certainly as we close in on the US election, there's easy political gain to be made with strong anti-China rhetoric. It's a good vote winner. Do you anticipate that there could be more constraints to come on China's economy from the US?
Oh, for certain. And I think for most institutional investors and certainly private clients that we talk to, there's little appetite to be buying Chinese equities ahead of the election result. But as we come out the other side, people like myself might talk about just writing this country off and this market off. But we've seen that every time the market falls just too far and there's a hope and there's a spark of news that things are going to be better, money piles back in, because there are very few parts of the world at the moment that offer the incredible value of Chinese companies and the valuation levels that we see that they're down to. And to be fair to those companies, they've been paying good dividends and buying back shares. Both of those factors typically good news for an equity market.
I was going to ask you if you had anything good to say about opportunities in China, and it's nice that you do, but in terms of actually putting money to work there, is that something you're doing? Are you being selective? Are you looking at some of those names that have good earnings and getting long?
We're not getting long in the sense of more than what we would typically have, but anything that we have left in the portfolio, we're just saying it's too late to sell. We're just going to sit this out because we cannot believe the leadership in China would just leave this part of their their economic system just festering with problems in the corner. They will want to address it. They will want their stock market to rise. We just have to be patient. And I think there's no sense in them doing anything ahead of the elections in the United States, because that may be just wasted money and wasted effort. Get to the other side, reset, and then hopefully we'll see policies that improve the background.
Do you feel that there is a risk in China that maybe the country gets old before it gets rich? And what does that mean in a political sense for the social contract?
Well, I think Xi Jinping and the leadership there are very sensitive to the mood in the country. And, whether it's the stock market or other things, they have to improve the mood of the householder. And they're all going to be needing to have that greater confidence in order to go out and spend what is still an incredible pool of savings that sits there in the banks. That money needs to be spent, vibrancy in the economy, and then higher asset markets.
All right, Gary Dugan of the Global CIO Office, thanks as always for joining us. We have plenty more to come. This is Bloomberg. Bloomberg opinion columnist Bill Dudley says he expects another rate cut in November. The former New York Fed president also told us the central bank has successfully delivered a message that today's 50 basis point move was based on good news, not bad.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the SOM rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today. And that's really hugely important, because if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you'd think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2% plus at an annual average rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they could pull it off.
That's Bloomberg Opinion's Bill Dudley speaking with our colleague Tom Keene. All right, let's take a look at what's moving in the markets around the Asia Pacific. Looking at Hong Kong property stocks, of course, as you'd expect, not long after the Fed cut rates, we had the Hong Kong Monetary Authority also cutting rates in lockstep. Nothing unusual about that, but it's been a real bonus for Hong Kong property stocks. You see Longfor rising by more than 7% at the moment. So we might see those falling house prices in Hong Kong finally arresting their steep decline. The Hang Seng Index more broadly is stronger, but tech and property gauges are really helping lead the way there. So the HKMA lowering rates by about 0.5 percentage point to 5.25%. Let's take a look also at SK Hynix. We did have Morgan Stanley downgrading the South Korean memory chip maker's stock, cutting the price target as well due to pricing concerns there. So SK Hynix now the least preferred among our global memory stock coverage. This underweight call becomes our top pick, according to Morgan Stanley. All right, so you see SK Hynix shares there off by about 8% in South Korea. All right, coming up, Blackstone Private Equity hails Asia as their growth engine, citing plenty of investment opportunities across the region. Our exclusive interview with their Asia head up next. This is Bloomberg.
Definitely did compromise here, but I don't see there's any big concern from the Fed that they need to continue to cut interest rates by 50 basis points meeting after meeting. They're going to be moving slowly and gradually.
If inflation doesn't continue to subside as the Fed projects, is that at some point markets may price in a bigger move than the Fed is able to deliver, and that potentially would disappoint markets.
The impact on Asian currencies, however, is going to be somewhat mixed, I think. I think it's worth emphasizing that the interest rate differential in the dollar's favor remains quite large. And even if the Fed were indeed to cut another 50 basis points by year end, it's still going to be quite large in the dollar's favor.
So the most important thing is the jobs market. Basically, if you look at the ADP, you look at the unemployment, you look at the NFP, if those numbers don't look good, then it doesn't really matter as much what the Fed does. People are going to sell the market. If those numbers look good, then, probably 25 basis points per meeting is the default.
Some of our guests there discussing the implications of the Fed's 50 basis point rate cut. Let's have a look at Chinese markets as they head to lunch. Pretty good day for the CSI 300, considering recent history. Better by 0.8% at the moment. We've got the Shanghai Composite pushing higher as well, and the yuan 708.60 at the moment. We've got markets in Japan rising very aggressively as well. The Nikkei better by 2.25% right now. We've got every sector on the Nikkei higher at the moment. And we do, of course, have the Bank of Japan with its decision coming up on Friday. The yen is an interesting one as well, weakening despite that 50 basis point cut from the Fed. Although our MLive bloggers saying enjoy that post-Powell dollar strength now because it's not going to last. And in terms of how equity markets are performing around the region, we've got every index higher apart from the Kospi. The Straits Times index in Singapore, meanwhile, better by 2/3%, and it is heading for its highest close since 2007. So we've got markets responding very warmly to that easing from the Fed. All right, for more on markets now, let's get to Bloomberg MLive strategist Mary Nicola. So, Mary, you've been writing about the implications for Asian equities, particularly emerging Asia, on the back of this supersized rate cut from the Fed. What can we expect to see?
Yeah, I think overall you're going to get a very strong bull market. You've got looser financial conditions while the U.S. economy is holding up pretty well. That spells a positive environment for Asia as a whole and Asian equities in particular, because at the end of the day, it's the U.S. economy that's been holding up it's the U.S. economy that's been holding up Asia, especially with the economic malaise in China. So if that continues, and then you have that coupled with some easing from the Fed, that is just a very benign environment for Asian equities.
So we are anticipating more Fed easing down the track. How much of this is priced in?
Yeah, I think one of the key messages from the Fed that it was more of, I would define it more as a hawkish cut. So they made it very clear not to expect more cuts of this size in the future, that the fact is that they're going to remain data dependent, and that growth is actually holding up. So it doesn't warrant such aggressive rate path thereafter. So I would think that given how much yields have moved, given how much rate expectations have gone probably a little bit too far, we could expect some pullback and some repricing of Fed expectations where it's not as aggressive as initially anticipated because of the Fed messaging from Jay Powell. And of course, what's going to be key is how the data unfolds. So no matter what the Fed is telling us, it's what the data tells us. And it looks like really the focus is on the labor market more than anything else.
So does that explain some of the moves that we've seen in the yen today? Because it has been somewhat counterintuitive, this weakening that we've seen.
Yeah, absolutely. I think there was an expectation that the Fed was just going to keep going a little bit more aggressively. They've reined a lot of these expectations in. And so now they're trying to digest what the Fed is trying to tell them. And I think the Fed is trying to say that, of course, we're going to remain data dependent, but we might not be as aggressive as you might think. That will give some repricing of expectation. That gives a bid for the dollar, especially if rates aren't going to decline as fast as the markets have expected. So, of course, in the meantime, what's been one of the biggest outperformers has been the yen, and that, of course, is suffering the most on the back of what we've seen from the Fed.
All right, Bloomberg MLive strategist Mary Nicola there. Well, interest rates exert a substantial influence on M&A dynamics, so let's get a view on how investors should navigate the impact of lower rates on deal making. Amit Dixit is here. He's head of Asia at Blackstone Private Equities. So, Amit, the Fed easing cycle's kicking off. Do you expect that to put a bit of life under M&A and fundraising?
Oh, absolutely. At Blackstone, we are in our prime. The activity has been very strong. And this interest rate easing cycle helps the alternatives business. So you've seen Blackstone's own stock price. We are at an all-time high, close to 190 billion in market cap. So that itself is a signal that it's going to get better from here on out. It's already been very good for us. For the last quarter, we have committed or invested $50 billion globally. So I think it's been a strong deployment capability already, and you will see this increasing as the Fed cycle sort of eases. Asia, which you asked about, is the growth engine for Blackstone. It's 35% of global GDP, but 60% of global GDP growth. And we see a lot of bright spots. India, Japan, Korea, Australia, Southeast Asia, and we've been very active across all these markets.
So if we take a look at India in particular, it's one of Asia's hottest stock markets at the moment. It's got a very fast growing economy. Where does this fit in for Blackstone at the moment?
Yeah, so India is our largest market in Asia. We've been in India for 19 years, and we have scale in India. If you combine the private equity and real estate assets in India, the total market value is over $50 billion. So if you look at Blackstone as a conglomerate, we'll be number 8 in the country, the only foreigner in the top 10. So we have scale. Importantly, we are a builder of business, not just a buyer of business. We are building, not just buying. So we have built the largest electric vehicle component company in India. Now we are building one of the top hospital groups in India. We built a large IT-enabled services company. We have sponsored 3 real estate investment trusts. So always building. And then finally, India is all about the ecosystem, not just Blackstone, but a large ecosystem of our partners, of our management teams who work alongside us, both to source our transactions and also execute these business building programs. So very active for us. Just in private equity, we have executed 10 transactions in the last 12 months, 4 new investments, all 4 bilateral in hospital, financial services, certification of diamonds, and in technology. And then we have had 6 realizations or exits, as we call in private equity. So very active market for us, India.
In terms of exits, I guess finding exits for private equity must be pretty easy at the moment with so much interest, so much foreign money flowing in, retail investors flowing in as well. But when it comes to the buying side of things, is that a bit more challenging? Because we do have a lot of questions being asked about some of the rich valuations we're seeing in India.
Yeah, that's a good question. See, our strategy is somewhat different. Yes, overall the market is hot, but we are in the private markets. We've executed 4 transactions in India in private equity, all 4 bilateral, away from the markets. So our latest deal is an insurance broker company, which is not announced yet, not in the market, just a proprietary deal. So we have a deep network in India. We've been there for 19 years. And India is a complex place. So what we thrive in is good businesses, but complex transactions. Because if the transaction is not complex, it actually goes to an IPO or goes to an auction. We don't play there. Or the deal before that, we actually put together a hospital group in India in a very complicated situation with the litigation going on. We were able to navigate that complexity and put together now, with multiple acquisitions, the 5th largest hospital group in India. The deal before that, again, a motivated seller for a diamond certification company, which we've just filed in 17 months to go public, which was a great business, but in a very complex cross-border setup. Or the deal before that, where it was a founder succession issue, where the founder was in Sacramento, the business was publicly listed in India, we had a bilateral, and we were able to execute that transaction, our 8th buyout in IT-enabled services. So again, we stay in the private markets, complex transactions, good businesses. So our valuations actually are quite reasonable, about 11 times EV to EBITDA entry multiple, even though India as a public market is quite hot.
Yeah, so how are you balancing your strategy? Because obviously, as you say, the public market in India is hot at the moment, but M&A opportunities are rising in Japan and Australia as well. How do you strike that balance?
I think it's the dynamic allocation of capital. We are pan-Asia, and Asia, as you know, is a bit of a misnomer. It's actually 6 uncorrelated geographies. We think of Asia as India for India, Japan for Japan, Australia for Australia. So we have deep local teams in each market. We've invested over $50 billion, over 400 professionals, 7 offices, and we are seeing activity locally everywhere. So for example, in Australia, we announced our largest transaction ever in Asia, AirTrunk, 24 billion Aussie of enterprise value to buy this data center company in Australia. In Japan, we have executed 4 transactions in private equity. Recently, we took Infocom, a women online comics company, private. We bought it from Taijin. Before that, a payment processing business from Sony. We carved that out, again, a bilateral transaction. Before that, a founder-run company, IROM, for clinical outsourced trials. Again, complex transaction, bilateral deal. And then very recently, the #1 vitamin company in Japan, Alignment, which we had bought from Takeda a few years back, we recently exited that investment by making into a fast-growing 11% growth rate with that company we exited. So Japan is very active. Australia is very active for us.
Just quickly, how much competition are you seeing in this space as well? Do you find a lot of sovereign wealth and pension funds are chasing the same sorts of assets that you're interested in?
Well, Asia is the growth engine. It's, the darling, especially few markets in Asia. But especially what you talk about, the sovereign wealth fund, pension funds, they actually are our partners. They invest in our funds and they partner with us on these transactions. So again, it's public news in India, one of the largest ethnic snacking company. We actually partnered, it's in the public domain, with GIC and ADIA to put together a bid for over $5 billion in equity. Or Bloomberg itself has a news out on Monday where our company, VFS, Visa Processing Company, where there's an interest from a sovereign investor to come in 2 years after we have come in. So we actually see the sovereigns, the pension funds, actually aligning with us and creating the ecosystem and allowing us, AirTrunk by example, Canadian Pension Plan collaborated with us. So actually it's a positive for us because they help us do larger deals and also come in and help monetization of those deals later on.
Just quickly, Amit, you mentioned the VFS deal there. Can you give us an update? Tell us how close you are to a potential sale. Has it been reported?
Oh, we are not contemplating a sale. It's not in the public domain. It's a minority investment with an aligned partner to actually help grow VFS for the long term.
All right. So how's that tracking? How close are you?
It's progressing well. I'm actually speaking to you from Singapore today, so it's on the right track.
All right, Amit Dixit of Blackstone Private Equity, thank you so much for joining us and for that update there. Let's take a look at Indian markets just ahead of the open. We're about 90 seconds away. It is a broadly risk-on day across the Asia-Pacific following that supersize rate cut from the Fed, 50 basis points, and we're seeing the pre-market in India reflecting this as well. The Sensex better by about 0.5% there. Indian Prime Minister Narendra Modi, meanwhile, is facing a new political challenge with voting underway in the region of Jammu and Kashmir. Almost 9 million registered voters will choose candidates for 90 seats in the local assembly, and it's the first such election since 2019, when Modi's government brought the region under federal control. Separatist sentiment remains strong, with some voters angry at their loss of autonomy. Latest on the conflict in the Middle East after a second wave of pager explosions in Lebanon. New details on the origin of the devices coming up next. This is Bloomberg.
tell you is we were not involved in yesterday's incidents or today's in any way, and I don't have anything more to share. It's too soon to know if what happened over the last couple of days is going to have any effect on where we are with the ceasefire deal. Sadly, we aren't any closer to that now than we were even a week ago. So it's difficult to see any immediate impact of these incidents, but I think it's just too soon to know in general.
Obviously, the logic of making all these devices explode, indication that this event confirms that there is a serious risk of a dramatic escalation in Lebanon, and everything must be done to avoid that escalation.
US National Security Advisor John Kirby and UN Secretary General Antonio Guterres speaking about the attacks in Lebanon using exploding pages and walkie-talkies. Well, the trail of exploding pages has been traced back to a post box in Budapest, as well as a Taiwanese company that licensed production of the devices. Gold Apollo's chairman says he doesn't understand how his company's become involved in what he calls the political stain, or the stain of a political terror incident. And Japanese wireless equipment maker ICOM says it's investigating after being made aware of reports that its devices may have been involved in the attacks. Asia senior editor Bill Ferries joins us now. So, Bill, what have we learned about these exploding walkie-talkies and pages and the trail of their manufacturing process?
Well, Paul, as you mentioned, the trail of manufacturing first led to Taiwan after authorities in Lebanon noticed that nearly all of the pagers, the thousands of pagers that exploded yesterday, seemed to have been a similar model manufactured by a company called Gold Apollo, based in Taiwan. It later turns out that the chairman of Gold Apollo said that he had licensed manufacturing of some of those pagers to a firm called BAC Consulting in Hungary. We tried to visit offices associated with BAC and largely found just mailboxes and offices that belong to different companies or government agencies. So a lot of details still to come out, but it does seem that there was some kind of an explosive material perhaps inserted into these pagers in the manufacturing process. And as you mentioned, there have been additional explosions, walkie-talkies, fingerprint readers, and things like that that have continued to go off. So far, more than 3,000 people injured, but seems to be a direct attack on Hezbollah members and some of their leadership. And that includes the Iranian ambassador to Lebanon who was injured in one of those attacks yesterday.
So what are experts saying about how explosives got into these devices?
Well, there was a lot of speculation early on whether it was, some kind of a electronic bug that caused the batteries to overheat and burst into flames. But it does seem like the consensus is centering around early in the manufacturing stage, very small amounts. We're talking about 1 gram, a couple grams of explosive material put inside of these during the original manufacturing and set to explode upon receiving a specific message. That message came through at about 3:30 p.m. In Lebanon time and seemed to trigger all of these pagers almost simultaneously, largely in southern Beirut.
So what's next for this conflict? Because Israel's talking about seeing a new phase in this war.
Yeah, Israel's making clear that they do see the shift of the war moving north. They've said that they would like the 70,000 Israeli citizens and residents who have had to leave the northern territory, northern part of the country that borders Lebanon. They'd like to see those people able to return. That cannot happen until there's less de-escalation in the violence between Hezbollah and Israel. Those two sides have been firing at each other almost on a daily basis since Hamas's attack on Israel October 7th last year. So Israel clearly trying to shift more focus, more troops, and more attention towards that northern area. The big question is whether this pager attack, if it was indeed done by Israel, whether that is just a shot across the bow of Hezbollah, or whether whether Hezbollah's response and Israel's further actions mean a much bigger escalation of a conflict that's been going on for almost 1 year.
In terms of retaliation from Hezbollah and possibly Iran as well, what would the mood be, or would there be a sense of trepidation here? Because Hezbollah just got compromised in a way that it probably couldn't have even imagined.
Right. I think from Hezbollah's perspective, they'd be wondering what other surprises Israel potentially has in store for them. I don't think we have a clear picture of how damaging this blow was to them. Hezbollah, you have to remember, is a much bigger and much better equipped fighting force than Hamas was even before hostilities erupted more than a year ago. They have as many as 100,000 militants in their organization, so much bigger group. And this did only affected about at the top end maybe 3,000 people or so. So they won't be completely incapacitated by this, but it will have them thinking twice about the phones they still have, other electronics they have, and other ways that Israel may have insights into their operations.
All right, Asia Senior Editor Bill Ferry's there. We have plenty more to come. This is Bloomberg.
There's a group of cryptocurrency advocates, Bitcoin advocates, et cetera, that are working alongside of her to distance the Democratic Party, the future of the Democratic Party, away from Elizabeth Warren and Gary Gensler. And I believe that we are making progress, and I think it's going in the right direction. And I will make this prediction that in the next congressional session, there'll be positive legislation and great clarity on stablecoins, great clarity on what we're going to do in terms of a regulatory framework that's fair for the industry.
At Skybridge founder Anthony Scaramucci there talking about his outlook for stable coins at a Token 2049 panel moderated by Bloomberg's Aslinda Amin. Let's take a look at how crypto assets are doing. Pretty well. Bitcoin back above 60,000 there. It's up about 3.1% today. And this is after, of course, we saw the Fed reducing borrowing rates for the first time since COVID, that supersize half basis point cut. The Bank of England is coming up next with its rate decision. That's due in just a matter of hours. Bloomberg Economics says the odds of the BOE unveiling a rate cut are low, with the next move more likely in November. Now, this is despite a pickup in services inflation in the August CPI report. Before we leave you, let's take a look at how markets are tracking. We are seeing yen weakness, 143.01 at the moment. This is ahead of the next big macro event for central banks, the Bank of Japan meeting on Friday. No change expected to rates, though. That is it from Bloomberg Markets Asia. Horizons, Middle East and Africa up next. This is Bloomberg.